Hey, it's Mark Ferguson with Investor More, and today I'm going to talk about where the real estate market might be going. So there's a lot of crazy things going on in real estate. Prices keep going up. Maybe they've leveled off now, maybe not. Interest rates have maybe leveled off now, maybe not. Inventory is still at record lows. We've never seen a real estate market like this, so it makes it very difficult to know where it might go. I don't like predicting or saying I know for sure what's going to happen, but we can look at the data, make some guesstimates about what might happen. And so far, not to toot my own horn too much, but I've been pretty close about saying what might happen in the past. People have been telling me for years and years and years another crash was coming. We haven't seen that. People were saying that interest rates were going to cause prices to drop significantly. We haven't seen that. And there's a lot of data that backs up why I said these things, and it's not just pulling things out of thin air. And we'll look at that data again today. So we'll look at the Realtor.com housing report, which has a lot of great data going back 5 years to see where things are at right now. We'll look at some new construction numbers. I'll talk about investors, what they're doing, and try and make some sense out of what might happen with the real estate market. Now, a lot of these things I know are contrarian to what other people are saying, but as those who follow me know, I don't make these videos to get views or make sensational comments. I tell you what I think is going to happen, and sometimes people like it, sometimes they don't, but I'm okay with that. All right, love the comments. I'd love to hear what you think of all this. Love to hear your insights too if you're seeing something different. Hey, I welcome discussion and people who don't agree with me as well. All right, so I love the Realtor.com housing reports. They do them every month because they show these trends right here for the last 6 years, actually, not 5 years, which is so nice to have. So dating back to 2017, which is the blue line, we can see the active listing count, or how many houses are for sale. And you can see 2017 had the most. And what's crazy is back in 2017, those were record lows, right? Those were record low listings. So much fewer properties for sale than the crash before. It's just insane how low it was then. And it's just been going lower and lower and lower. So, for example, I don't have the data right now. In 2006, there were 5 to 6 million houses for sale in 2006. That's before the crash. And now in 2017, there was just over 1.3 million. Now, there's 669,000. So we aren't quite at a record low for active listing counts. 2021 was lower, but we're below 2022 and very close to 2021. And you can see there hasn't been a massive increase in houses for sale. 2022 saw absolutely crazy record low amounts of listings. They jumped up a little bit with interest rates going up, then they leveled off, and now we're seeing just a very normal curve of what we've had before. So I don't see a massive increase in listings coming anytime soon. High interest rates do that. And I've said that for a very long time. When you have higher interest rates, people don't sell because they don't want to lose their low interest rate. Building slows down, which we'll look at here, which means fewer listings. And it slows down investors too. And I know, the hot topic is trying to stop investors who are destroying the housing market, right? Well, I flip houses, I own rental properties. And when I flip houses, or even multifamily properties, a lot of times we take properties that aren't livable and we make them into livable properties. We're adding inventory into the market. Well, if interest rates are higher and there aren't as many sales because the market definitely slows down, prices might not drop, but the number of sales drop with high interest rates. Well, that means it's harder for house flippers and investors to invest with higher interest rates, or maybe they're scared to do it because they don't know what the market's going to do. That means even lower inventory. Investors help the market. And one stat I love to talk about that most people who don't like investors don't like this stat is in the last 3 years, 50% more investment homes were sold than bought. So investors were selling way more than they were actually buying. All we hear about in the news and media is how investors are buying up everything and buying record amounts of homes. Well, they didn't mention they are selling even more of those properties, putting them back on the market. And the reason people say, well, you can't just make up houses, Well, if investors are selling 50% more than they're buying, they're being sold to owner-occupants. And that's why the owner-occupant rate has been going up since 2006. It's gone from 62% to over 66% now. Huge amounts, many more houses are owner-occupant houses now compared to 2016, percentage-wise, not just, it's crazy the differences. So Investors do help the market too. Higher rates make it harder on investors. So total listing count, the total amount of houses, that is a record. So if you can see that, we're at 1,099,000 total listings, and this includes houses that are under contract, all houses for sale. That is a record low, below 2021, below 2022. You can see how low this was before. And the reason that's important is because for there to be a crash, there's been 4 crashes in the history of the United States, 2008, 1930s after the Great Depression, 1878, and like 1847 or something like that. Every single crash was caused by horrible lending guidelines, and those horrible lending guidelines that allowed almost anyone to buy a house, which meant building exploded because builders knew there were tons of people to buy their houses, and they overbuilt so that there was massive oversupply. And that massive oversupply caused a crash because they had to keep dropping them until they could sell stuff, or they went to foreclosure. Banks had to, sell them for much cheaper. We've never had a crash with low inventory. That's why that's important. And if there's low inventory, basically the cost to build houses drives prices, and that's how it works with almost any product, right? If it costs you $400,000 to build a house and there aren't enough houses, they're not just going to magically drop in price. They're going to stay close to that cost to build. And so unless prices keep going up to a point where it makes sense for builders to build, they're not going to build very much, which means it's just going to keep pushing prices up. Or if there's something that happens that suddenly makes it cheaper to build houses, that could lower prices too, but I don't see that happening in the near future either. TVs got cheaper to build. Their prices decreased. There's not many other products that get cheaper to build except for electronics because of technology and learning to do things better. So we'll see. I do have a video on the, people talk about the concrete or the 3D printing houses, and how those will make things cheaper. That technology is so far away. Who knows if that will ever be cheaper. It's just building the walls of the house, and it takes quite a while to get everything set up, and those houses aren't any cheaper. I did a video on that a while back too if you want to see that, but that technology is not making things cheaper. So who knows, maybe something will come up that makes housing cheaper, but for now it's really that cost to build that drives prices. All right, pending listing count, same story. These are homes that are under contract, pretty low compared to normal, not record breaking, but pretty low. And that's what you see with high interest rates is you don't see as many houses selling because not as many people can buy, but you don't see prices decrease either because there's not a surplus. There's not an over, just all these houses sitting there vacant. Of course, a lot of people will say there's that too. There's about 15 million houses vacant in the U.S. right now. Almost all of those are houses for sale, being remodeled, being ready to rent. And then there's some houses that are seasonal, where people only live there part of the year. And there's, some Airbnbs, that's a tiny percentage. And then there's abandoned and, dilapidated homes that can't be lived in. And there's a very tiny small amount that are livable homes. They're just held vacant for some reason, almost none. So in 2016, there were 20 million vacant homes. Now there's 14 to 15 million. There are not just all these vacant homes sitting around being held off the market. That is also another myth out there, and I've done a video on that too. All right, moving on. Newly listed homes, record lows still. Nobody's listing their house because interest rates are too high. They don't want to move because they'll know they'll have to buy a smaller house for the same amount of money. And we're going to see this keep happening as long as interest rates are high. So this drops off at the end of the year, and we could see even lower inventory. Days on market. A lot of people talk about how days on market shot up and went crazy in 2022 because of interest rates, and you can see it was record low. It was the lowest it's ever been, and then it did go up slightly higher than it had in the past. It still never got close to those previous years before COVID. It passed up 2021 and 2020 a little bit, but nothing significant as far as days on market. This is the pink line here. It says 2023. We can follow it down here, and it's still way below pre-COVID years, but slightly above 2022 and 2021, which were record low years. So days on market doesn't indicate anything crazy happening either. And then the median listing price, which is always interesting to see here as well. So you can see every year It's bumping up, bumping up. 2022 saw the highest increases in a long time. As you can see, that chart going straight up here. We hit our peak in June of 2022. And then interest rates shot up. We did see a decrease, which people said, oh, the crash is coming. As you can see, every other year, there was a decrease as well too, except for the COVID year, but we still saw a decrease at the end. That's how seasonality works in real estate. It goes up at the start of the year, hits a peak, starts going down at the end of the year. That's how it happens every single year. 2022 was just more pronounced. It went up higher, then dropped slightly more, but it was still, as you can see, above. So we never actually saw prices get lower, except for June, July of 2023. Prices were slightly lower than 2022, as you can see, just like 1 or 2%. Now they're back up again. We're not seeing as big of a decrease as we saw last year. Prices are again at record highs now. So prices are at record highs, inventory is at record lows, even with high interest rates, because that's what's always happened in the past. People stop selling, buying does slow down, but if you have both sides of supply and demand going down at the same time, that doesn't produce an imbalance, which could cause a big crash. So I don't see a huge change coming anytime soon to the real estate market as far as a crash coming, that's for sure. Price reduced share, you can see the pink here, 2023, again, every single year. April seems to be kind of the lowest point, although there were some lower points here, and then it goes up in the spring, summer, and you can see 2022 had a crazy amount of price reduced shares as people kind of freaked out from interest rates. And that was also another indication that many people said was a crash was coming, which it never got to really that high. It got pretty high, but then you can see it dropped back down just like it does every year. And now they drop back down even more, and we're right in the middle of price reduced shares. Nothing crazy happening there either. So from the Realtor.com reports, we can see real estate's doing fine as far as prices go. Yes, there's fewer sales, there's less affordability, but both sides of supply and demand are dropping at the same time, which doesn't create an imbalance. And with interest rates being as high as they are, those aren't going to fix prices. Interest rates are not going to decrease prices, as we've said before, not just for these reasons. And in fact, high interest rates could make all of this worse in the future as far as prices being higher goes. And I'll show you that here with these charts. So right here is the Fed economic data from the St. Louis Fed Bank. Amazing data. This is new privately owned housing starts total units. And so this was before the housing crash. Lots and lots and lots of building for many, many years, caused an oversupply, as we talked about. Then the crash hit. We realized a lot of those loans were made of nothing and were worthless. Huge crash in building, right? We were at record low building for many, many years. We finally got back up at the start of 2022 to kind of normal building, or at least maybe even slightly above normal, which is what we need. We need more building because there's record low building for so many years. Interest rates went up, boom, automatically a huge decrease in building, kind of leveled out, went up a little bit in May, boom, a big drop again in August. Building permits and housing starts are way down again. And what does that mean? Well, builders are scared to build with high rates because it makes fewer buyers. It puts uncertainty in the market. And with less building, that means lower inventory in the future. So these high rates that we have right now, while Powell says he wants to put the market in balance and high rates will help do that, what it's doing is making it worse. It's making less inventory for the future, which will mean prices will be higher. What we really need is more inventory. We need to balance out the inventory issue, and the way to do that would be lower rates and build more. But the Federal Reserve, not quite the federal government, is doing the opposite. So we can look at other things too on Fred in single family units, right? That's even more interesting in that we can see how many single family houses they built in 2005 and 6. That was total units before, which includes multifamily condos, things like that. Actually, condos are still single family, multi-family apartments, fourplexes, things of that nature. But you can see they built way more houses than they had in the past. So this is way more pronounced. And then they had a huge drop again. And we never really got back to normal. Maybe we got just past normal. Again, massive drop in building again, got back up, and then not as pronounced of a drop in starts for single family as there were multifamily, or total units. Still, we need more houses. We aren't building enough. Like the last time we built this few houses, maybe 95, maybe 93, and we have a shortage of houses. We need to be building like way more than normal to catch up, not below normal. And that's just going to make it worse too. So these high rates are just going to keep making things worse and worse. So there's lots of different things. People will use this number to say that there's too much building going on and a crash is coming. This number is new privately owned housing units under construction, total units. So this means all the houses currently under construction. Some aren't even started yet. The building permits are pulled. And you can see this number is like record high. And people point to this all the time, say there's record amounts of building. There's going to be record amounts of inventory coming on the market because of this. But what they forget is that it takes twice or three times as long to build now as it did before because of labor shortages, because of supply chain issues, because of development delays, building permits. All of those things make it so much harder to build. Because you could see before, we'll look at completions too, we have way more houses or properties under construction than even 2006. But there aren't that many houses being completed. That's because you could build in a half or a third of the time. So while you didn't have as many, under construction at one point in the future right here, you could build those way, way faster. So you didn't need as many under construction at one point. They just kept, flying out of there, getting finished. Now they're just sitting there taking forever to be built. So you just have this buildup of houses under construction that aren't actually being finished. And so this is a very misleading stat. I would much rather see building starts or building completions than under construction because there's a lot of projects being halted, things aren't getting started. That's a very deceiving stat to use. So be careful when you see that stat of under construction. All right, so if we keep going down here, completed. See, these are the houses completed. There you go, right? You can see the huge difference of 2.2 million units being completed in 2006, even though they had less total properties under construction, versus now we're at 1.3 million total units completed, almost a million less, even though there's more under construction. So be careful with those statistics. So what does all of this tell us? What does this data tell me? I know there's all kinds of different factors out there. People love to pull out affordability and say that the U.S. housing market is too unaffordable and that will cause prices to crash. And the problem with that is that, let's see as I type and talk. The problem with that is, there we go, look at that. Lots of typos, but I got it done. Affordability doesn't matter. I know people hate it when I say this. Houses don't care how much people make. That might sound mean or harsh, but the issue is that the cost to build is what matters, right? Like, TVs didn't get way cheaper because people couldn't afford them. People were still buying TVs. They got way cheaper because the cost to build went way down. And when the cost to build went down, a company came in and said, hey, we can sell this $1,500 TV for $1,300 and we'll sell way more and beat our competition. So let's do that. And the competition said, oh man, well, we figured out a way to sell ours cheaper, so we're going to keep selling them cheaper. The technology allowed them to sell them cheaper and capture the market. Same thing for houses. If you could build what it costs, say it costs $400,000 to build a house today. If it only costs $300,000, a company's going to come in there, build houses for even $350,000, still make money, and say, hey, we can sell more houses, build more houses. House building companies want to sell houses. That's what their main purpose in life is. If they could build it cheaper and faster, they would. There's so much demand out there, they would, even with higher rates, and we didn't see it happening even before with lower rates. The problem is the cost to build. And houses won't just magically get cheaper because the affordability goes down, unfortunately, unless there's a massive, massive surplus of houses for sale, which the opposite is happening. So this is numbeo.com, and this is the property price index by country 2023 mid-year. This is how affordable it is in every country in the world, almost every country. They might not have all of them. So the price to income ratio let's see here. We can change this, or we should be able to. There we go. Price to income ratio. The cheapest place from price to income ratio to buy in the world is Saudi Arabia. They have tons of owner-occupant programs. Oman, United Arab Emirates, South Africa. The United States is 5th in the world for the cheapest place to buy houses, price to income ratio. So even though affordability is worse now than it was before, it's still cheaper than almost everywhere else. So just because houses are less affordable now doesn't mean they're unaffordable, right? Like, who decided that prices, 3 years ago, that was the max affordability for people? No one knows that. Maybe lots of people were buying. We had owner-occupant rates going up. They're less affordable now, but that doesn't mean they're unaffordable. People are still buying, houses are still selling. So you can look at gross rent. Let's see here. That's the yield, so that's what people make. Not really applies to owner-occupants buying. Price to rent, city ratio. The United States is more expensive than rent. It's 16. So it's still way more affordable to buy than to rent, at least as far as a country scale in the United States. And then mortgage is a percentage of income. This is a good one too, because this shows us how much your actual mortgage costs versus your income, not just the price of houses, because mortgage rates have changed. And here the United States is sixth most affordable mortgages in the world based on income. So for people who think it's very unaffordable in the US, it is less affordable for sure. I'm not arguing that. It's gotten more expensive, but compared to the rest of the world, it's still very affordable here. And why does that matter? Because if we look at the rest of the world, who's had way higher housing costs, way higher mortgage costs compared to income, just way high. I mean, we're not talking about a little bit higher, way higher. It's like the United States is 38% of income goes to mortgage according to this charts. Well, if we go to Finland, it's 51%, right? If you go to Japan, it's 57%. If you go to Italy, it's 64%. Sweden, 64%. United Kingdom, 65%. Switzerland, 68%. Austria, 69%. France, 70%. Germany, 70%. They're like two times more expensive compared to income to buy in other countries. And the point is, those countries haven't seen a crash. They haven't seen prices dropping. They are twice as unaffordable as the US, and that has not caused prices to drop. So I just want to point out that just because it's less affordable now, that's not a reason why prices will drop. So many people say, oh, there's an affordability index, and when houses go below it, they have to go, or when houses get too expensive, they have to drop back down to that. No, they don't. Other countries have shown that over and over again. So finally, we'll get to my predictions of what will happen. It's hard to know what the Fed government will do with interest rates. I could see them raising it once or twice more because that's what they like to do. I won't get into that too much. I have another video on that. If they do that, it's not going to lower prices. It's going to make building harder. It's going to lower inventory. It's going to make this problem worse down the road as far as our not having enough houses. As soon as they start lowering rates, which hopefully they do sooner rather than later, that will allow more building to be done. That will allow more investors to buy houses and put more houses on the market. That will allow sellers to say, hey, now I can buy another house. I'm going to put my house on the market now where I wasn't before. It's going to create more inventory, which is what we need. But lower rates is going to create a massive amount of buyers to come back into the market too. So again, just like we saw inventory and demand drop below, but still kind of stay in balance or out of balance actually. If interest rates drop, we're going to see inventory go up. We're going to see demand go up too. And there's no way to fix that. You can't just magically make demand go away. People need a place to live. People need houses. They have to live somewhere. The only way to fix that, which is going to be very painful and take a long time, is to increase inventory and keep increasing inventory as much as you can. Build houses. And the faster rates are lowered, the faster they can build houses, the faster they can try and hopefully help to fix this issue. Although it could be very painful if we have a huge demand of buyers coming into the market, we could see prices jump again. That is not out of the realm of possibility. I see very, very little chance of prices dropping more than seasonality. This time of year, they might drop a little bit because it happens every year. Besides that, I don't see a crash coming. I don't see anything massive changing there. Now, something that could be done to help this as well, which I doubt will happen, is they could make it easier to build. They could make it easier to develop. They could make it easier, to like supply chain issues. We could focus on that, which again, interest rates would make that harder too, because it's harder to expand, harder to fix supply chain issues when interest rates are high. So if they could fix supply chain issues, which lower interest rates could help, could make material slightly cheaper, that could help as well. So we'll see what happens. My prediction is kind of a steady to slightly rising, or maybe steady to slightly declining market the rest of the year, just because that's what seasonality does. The start of the year, we'll probably see things start to pick up again. If they drop rates, which they probably will at some point next year, we could see another boom in real estate. We'll see what happens. I've got lots of videos on the housing market and crashes in the past that I've done for many, many years, and I'll keep doing them. I'm not pretending to be right all the time. I don't have a crystal ball. I could be wrong. That's just my best estimate. All right, thanks for watching. Let me know what you think, and we'll be back with more of my other videos on my rentals, flips, laundromats, businesses, stuff like that.